You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Comprel. An abrupt slowdown in U.S. population growth has led some Fed officials to argue the pace of job growth needed to keep the labor market in balance could be zero or even negative. Productivity gains have kept the economy growing for now, but a shrinking workforce puts that growth and assumptions for rising asset values at risk. And as retirements exceed new entrants into the labor force, federal programs like Social Security are coming under further pressure. On today's episode, we talk with Stan Veuger, Senior Fellow in Economic Policy Studies at the American Enterprise Institute, about what's behind the recent slowdown in U.S. population growth, how it will impact the federal deficit, and what it means for interest rates in the future. Stay tuned. Coming up soon, our interview with Stan Veuger, but first, a quick market update. Traffic in the Strait of Hormuz is still effectively zero as the U.S. and Iran struggle to find a sustained peace agreement. The indefinite ceasefire is limiting the risk of escalation at this point, but with no deadlines or ultimatums to monitor, commodity suppliers in the region as well as global investors are stuck in a holding pattern. The Fed left interest rates unchanged this week, as expected. FOMC participants are still waiting for more data before determining how the war has affected the two sides of the Fed's dual mandate. 3 participants dissented, preferring to remove the easing bias in the policy statement, but still supporting the policy decision. The Department of Justice dropped its investigation of the Fed's headquarters renovations last week, handing the inquiry fully over to the Fed's Inspector General. The move was enough for North Carolina Senator Thom Tillis to withdraw his opposition to Kevin Warsh's nomination to become the next Fed chair. The Senate Banking Committee voted 13-11 for Warsh, and his candidacy next heads for a vote in front of the full Senate. At this week's press conference, Chair Powell said he will stay on as a governor indefinitely until the Inspector General's investigation is over. Investors largely dismissed the March PCE and first quarter GDP data this week as stale representations of the pre-war world. The headline PCE deflator rose as expected because of a rise in gasoline prices. Moving forward, the important questions are whether higher energy costs get passed on to core consumer prices, and whether the hit to disposable income causes a meaningful downshift in economic activity or employment. Yields steadily rose across the curve over the last 2 weeks in step with crude oil prices. 10-year Treasury yields broke through 4.35% this week, but are still a leg lower than their 4.47% year-to-date peak at the end of last month. West Texas Intermediate was as cheap as $82 on April 17th, before trading above $107 earlier this week. There's no sign of the U.S. and Iran coming to a sustained peace agreement anytime soon, but the lack of any material escalations helped risk assets rebound after a dreadful March. That's all for the market update this time. Now our interview with Stan Veuger. Our guest today is Stan Veuger, Senior Fellow in Economic Policy Studies at the American Enterprise Institute. Stan, thanks for coming on the podcast.
Thank you for having me on.
Our topic today is the economic impacts of declining U.S. population growth. Now, back in January, the U.S. Census published its annual population growth estimate and said that the population had grown 0.5% between July 2024 and July 2025. That was down from 1% growth over the previous 12 months. Stan, what's behind the sudden slowdown in population growth over that period, and how does 0.5% compare to the rest of U.S. history?
So what mostly happened during that period compared to the final 2 years of the Biden administration is a slowdown in inflows, especially on the southern border, but also through the elimination of a number of legal pathways by the Trump administration. The numbers you mentioned, of course, only cover the period up to the end of June of last year. The pattern has persisted and intensified since. We estimate that in 2025 as a whole, net migration was probably negative, actually. So not just a slowdown in growth, but we think net migration for 2025 was between minus 300,000 and zero, a number like that. Now, to put that into context, before the pandemic, net migration per year was about 1 million or so. So you can think of that as sort of the normal number. The number went up by quite a bit during the later years of the Biden administration to well above 2 million. So now we think we're in negative territory. So that's a pretty big decrease.
So when you say net migration, that of course means inflows versus outflows. You addressed the slower inflows, but outflows have remained consistent. I mean, I think sometimes people forget about this, that just naturally people who are foreign born are always going to be leaving the country because they retire, they might die, or they have saved up enough money, and that was always their intention as a temporary resident, and they go back to their original country. Have those outflows changed at all, or is it just the inflows?
The outflows have gone up a bit too, but I think for a reason that people don't immediately think of. So, because we had such large inflows in recent years, we have many more people who've only been in the country for a very short period of time. And those people are much more likely than long term residents. And so that's, I think, a big part of the story, too, that we had 3 to 6 million additional people who came into the country between 2022 and 2024. Those people are much more likely to leave. They do not always have family connections here. They are not homeowners. Their legal status may be either tenuous or temporary. And so that's, I think, the main explanation for increased outflows. But again, the decrease in inflows is much larger. So, you had fewer people come to the southern border starting sort of mid 2024. So that started during the Biden administration. Now inflows are at very low levels through that route because of the Trump administration's decisions to close down the border, to make applying for asylum much harder, et cetera. The other large decrease in inflows comes from changes to legal programs. As you may know, we have a refugee resettlement program where people come to the country with a path to citizenship. They arrive legally. During fiscal 2024, that program admitted about 100,000 people. The Trump administration has basically ended that program, except for a small group of white South Africans. And so that alone is a drop of about 100,000 year over year. Similarly, the Biden administration created the so-called humanitarian parole program for Cubans, Haitians, Nicaraguans, and Venezuelans, through which nationals of those countries could enter the U.S. legally if they had a sponsor. That program admitted about 400,000 people in fiscal 2024, and the Trump administration terminated that program entirely. Just those two programs, which are not very high profile, led to a reduction in that migration of about 500,000 between the end of the Biden administration and now.
What about changes in what's called the natural population growth, which are the birth rates and death rates for people who were born in the U.S.? Have those trends changed over the last 6 or so years, or is this decline in population growth really just happening against a backdrop of the slower inflows of net migration?
I don't think we've seen drastic changes there. Fertility has trended down for a long time. Mortality went up a bit, of course, during COVID, but since then, nothing dramatic has happened there. But the decrease in natural population growth does mean that in the absence of positive net migration, we basically have no labor force growth. And so that is, I think, from an economic perspective, very important, that basically all of the growth we see in the labor force has been coming from net migration. And so as a result, now that we're in a situation of about zero, maybe slightly negative net migration, that means that the labor force has stopped growing. And that's immediately reflected in employment growth, right? So in the monthly job numbers, I I assume many of your listeners will know that the monthly jobs numbers have really dropped dramatically over the last year and a half. And my view, and I think by now sort of the conventional wisdom in markets, is that is mostly driven by changes to immigration policy. During the peak years of the Biden administration, you'd see monthly jobs numbers of maybe 200,000 plus. Right now, we've been around zero for quite some time. My work with colleagues from the Brookings Institution predicted that and shows that you can basically explain that whole drop, or the overwhelming majority of it, from the reduction in that migration.
And this is something really important that Fed officials have been discussing for the last year or so, is this concept of break-even job growth, which is how many jobs need to be added every month for labor demand and labor supply to stay in balance. Essentially, how many jobs need to be added to accommodate the changes in the labor force. And your estimates are that we can have a labor force still in balance even with zero jobs added on net every month? Or what is your estimate for break even job growth?
That's right. So the way I think about break-even job growth is so the number of jobs that has to be created each month. So the number of people on that who have to find employment each month for the unemployment rate to remain constant if we have, constant labor force participation, basically. And so our estimates for 2026 are sort of around zero. Under our what we call our low immigration scenario, it's between minus 20,000 and plus 20,000. On the high immigration projections, it's a little bit higher, maybe 10,000 to 50,000. So, on balance, maybe slightly positive, but basically zero, indistinguishable from zero. That is still, maybe marginally positive, in part, of course, because it takes people who enter the country a while to join the labor force. And so, there's a bit of a lag in these monthly break-even numbers relative to actual immigration flows. This is basically around zero now.
So just to make sure I understand, if we have about 0.5% of overall population growth, but break-even job growth is closer to zero,
We no longer have 0.5% population growth.
that's kind of a stale estimate.
Yeah, because so that's the census estimate for mid 24 to mid 25. That includes the last half year of the Biden administration. I think the number has come down since.
Is it also fair to say, though, that of whatever population momentum we do have, there is an increase in baby boomer retirees, which means that the growth in the working age population, 25 to 54, however you want to define it, is going to be lower than the overall population growth going on right now?
That's true for sure.
According to the Social Security Administration, there were 5.1 workers for every Social Security beneficiary in 1916. Right now, or at least according to their last estimate, it's about 2.7. What does this mean for the federal deficit if the retiree population is increasing, but the working age population is steady or even declining?
Well, it's not good. Yeah, it simply makes it much harder to finance these old age programs, right? As you said, just there's fewer workers per retiree, and so the burden per worker is greater. All of our major programs, Medicaid, Medicare, Social Security, are basically funded on a pay-as-you-go basis. Of course, over the past 50 years, we've made some changes to these programs that have made the financing a little easier. But we've increased the payroll tax in various ways. We have raised the normal retirement age for Social Security. And so we've made some changes there, but it's been a while since we've done anything serious. No, if we don't change policy, that just leads to sort of increasing pressure on the budget and increasing budget deficits. Though I have to say, the increase we've seen in the budget deficit over the past 25 years is definitely not mostly explained by these slow moving changes in Social Security and Medicare. It's also just reduction in taxes and increases in spending in other areas. If we had kept policy the way it was in 1996 and had just gone through the changes that Social Security and Medicare had gone through, our budget deficit would not be, 7.5% or whatever it's going to be this fiscal year.
Where do you see that ratio, 2.7, according to my last reference by the Social Security Administration, going if current trends hold? So we have these changes in migration inflows, and the baby boomers, of course, will eventually, be replaced by Gen X as the oldest generation. So will that ratio keep going down, or does it plateau, at 2.5 or something?
So I think it plateaus lower. So I think the projection is that it will fall below 2.5 already about a decade from now. So maybe 2.3 or so. There are some projections that Social Security makes that I think are overly optimistic because they project an increase in fertility rates, which we really haven't seen any timing in recent memory. So it wouldn't surprise me if we go down to 2 or something like that actually in the next few decades. It's very difficult to change that because if we don't increase immigration, in the short run, if the fertility rate goes up, the first like 25 years, children don't produce a lot of outputs. And so it really takes a while to bounce back up. And there's a little bit of tension there between the year-over-year budget deficit and the long-run health of these social insurance programs. In the short run, a fertility increase, mostly increases spending. In the long run, of course, you have the additional tax revenue from new workers.
There's a lot of the market economy, I feel, is structured around an assumption of population growth and economic growth. So, at an individual level, I save or invest today because I believe I will get a positive return in the future. But at the economy wide level, that assumption works only if there's a bigger pie to share. The economy is bigger tomorrow than it was today. How do those debt dynamics change if the population gets to the point of shrinking?
Is definitely, I think, bad news for aggregate population growth, on which, of course, a lot of returns depend. It is true at the same time that we have some productivity growth and capital deepening in addition to just population growth as a means to create economic growth. And so maybe we can get productivity growth up a bit. That's not been easy, but at least some people now are optimistic that our new technologies will help on that front. But I agree, all else equal, you'd expect a lot of asset prices to be correlated with population growth.
We talked about how the federal deficit would come under strain through a lot of these trends, but what about in the private sector at a sectoral level? What industries do you think are most vulnerable if population growth stays low or even goes negative? Because a lot of, banking or insurance is also premised on this idea of a pay-as-you-go system, or the economy will be bigger in the future, and so that's how they, fund liabilities today. What sectors do you think are most vulnerable?
Every sector really, like the very long-term trends matter for everyone, whether you're a utility or you produce laundry detergent or you build housing, right? It's somewhat difficult to think of industries that do not grow when the population grows. The changing population dynamics more important for some industries than for others. Of course, what we've seen now for decades is that with an older population, the healthcare industry becomes more important. On the flip side, if we have fewer people under 30, that is a big problem for the education industry. And you're already seeing, especially private institutions of higher education that are not, the highest ranked ones are really struggling. And you see some of them closing. I think last week, Hampshire College, which is a relatively well-known private liberal arts college in the Northeast, announced it was closing down.
Of course, the idea of negative economic growth. I mean, you talked about how, because of productivity gains, we've been able to have decent economic growth, even if break-even job growth is about zero. But let's, consider a scenario where economic growth goes negative. What if our per capita income is still improving? Isn't that what really matters most for our standard of living? More than just that big top line number of GDP, it's really per person how much our standard of living is increasing.
There's some truth to that. Uh, but I also think there are numerous things that do depend on sort of total output. For example, if you think of our national security apparatus, that's easier to fund if you have a larger population, larger total economic output. If you think of a lot of assets separate from sort of year to year income flows, as we discussed, a lot of assets will sort of automatically increase in value as total GDP goes up. I think it's a little too simplistic to just focus on per capita annual output.
I think there are some foreign countries who have experienced this decline in population growth much earlier than the US. Some European countries come to mind, Japan. Do you see any experience abroad and think that it foreshadows the path that the US is going on?
The countries that have experienced like meaningful population declines are there's a couple of countries in our hemisphere, but Cuba lost about 20% of its population over the past decade. Venezuela, of course, lost a large share of its population over the past 15 years or so. Those I don't think are comparable situations because there was this large crisis and very sudden outflows of often working age people. The outflows have been less dramatic, but similar in sort of the type of people leaving in some countries in Eastern Europe that saw big reduction in population. And so, the most comparable cases are going to be countries that are relatively high income and where it's really been aging and reduced fertility that have been the issue. And so then you think about Japan, South Korea, maybe Italy, Spain. I think those are probably the most comparable, though the US is, I think, quite distinct still in some ways, more economically dynamic, large national debt, but not as large or as burdensome as Italy or Japan. But I think those are the most comparable cases. And then, then you can think, like, do we think Japan and Italy are on a trajectory we find attractive? I don't know, some pros and some cons, but it's difficult because so many things are different culturally and economically between our countries that I don't know that we can necessarily draw very precise lessons.
Those examples of Italy and Japan are maybe instructive as we think about how interest rates are going to adjust to new trends in population growth. And we talked about the pace of break-even job growth maybe approaching zero. And of course, the Fed's mandate has to do with full employment rather than any sort of set amount of economic growth or job growth. But how do you see all of this interplay working for interest rates generally? If we look at examples of, Italy and Japan or other countries with slower population growth, does that lead to deflation or what is the impact on interest rates?
So this is one area where I do think they illustrate the potential scenarios. So Japan is really the poster child for the secular stagnation narrative that you often heard before COVID. As you noted earlier as well, returns may just go down if there is much slower growth and as there's aging, people save more. Maybe we see interest rates go down and it's very difficult for monetary policy alone to change that. Italy, in some ways, highlights, and I don't want to say that this is purely because of demographic developments, highlights the alternative scenario where slower population growth makes the debt burden harder to manage and can lead to a sort of a loss of faith in government securities, and with that, to much higher interest rates, mostly driven by an increase in risk premium, maybe, as opposed to sort of underlying expected growth rates. And so I think those are two scenarios to keep in mind. I think people are more skeptical now of the secular stagnation story than they were 10 years ago, because it turns out if you do a lot of government spending and lose monetary policy, you can actually get the rates up again. But I do think those are two scenarios to keep in mind as you think through these developments. They're very different scenarios. And so you still have to think through, what world are we going to find ourselves in? Is it the secular stagnation world illustrated by Japan, or is it the more, debt crisis-y world illustrated by Italy at times?
Yeah, I feel like there are a lot of cross currents working there where lower population growth or lower economic growth would be a downward pressure on rates. But if there is a lower supply of savings because the workforce is shrinking and the debt becomes more difficult to manage, that causes long-term interest rates to go up. But as far as we can tell on net, the impact should be lower interest rates.
I would think so. I think you really need a crisis element for the upward pressure to materialize. It may also be the case that if you have a population structure that is not just aging, but also quite uneven, as we have with the baby boomer generation, you could have a dynamic where one particularly large cohort saves a lot and then starts dissaving in retirement. Though I don't think there's much evidence of that in the US at all, that the wealthy boomers, I don't think they actually dissave as much as a typical life cycle model would predict.
Stan Veuger, thanks for coming on the podcast.
Of course, thank you.
That was Stan Veuger, Senior Fellow in Economic Policy Studies at the American Enterprise Institute. I think investors are slowly accepting the idea of break-even job growth being close to zero. But Stan points out that stagnant employment can only coincide with solid economic growth if the economy maintains solid post-pandemic productivity growth. There's no reason to think that productivity will slow anytime soon, but the risk of negative economic growth and everything that comes with it is another way the economic trajectory is relying on AI fulfilling investors' optimistic predictions. The April jobs report next Friday will show whether the labor market continues to maintain its delicate balance after 2 months of higher energy prices caused by the war. The consensus expects the unemployment rate to stay at 4.3% and for payrolls growth to slow from 178,000 in March to 63,000. Earlier next week, the ISM services for April, JOLTS for March, and ADP employment data for April will give investors several tradable data reports. The bond market is primarily focused on signs of rising price pressures from the war in Iran and any inflection point in the labor market. Also next week, Treasury will publish its latest quarterly refunding announcement. After relying more on T-bills the last few years to finance the deficit, Treasury is expected to soon prepare markets for higher coupon issuance either in the fourth quarter or sometime next year. The following week, the April CPI and PPI will show how higher global commodity prices are flowing through to consumer and producer prices. Gasoline prices are slightly higher from where they ended March, but Fed officials will be looking for any pass-through to the core. On May 14th, the April retail sales data will give a glimpse into whether consumers are cutting back on core spending because of higher gas prices. Fed officials are free to speak publicly now that the pre-meeting communications blackout is over. A handful of appearances are already on the calendar, and we expect more could pop up if FOMC participants feel the need to respond to data surprises or turning points in the war. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.